Well, we have a veteran investor with us, so no wasting time on stocks at this point in time. Marc Faber, editor and publisher of the Gloom, Boom and Doom Report, joins us. That's a very euphemistic way of introducing Mr. Marc Faber, who is a veteran investor across asset classes. Mr. Faber, good afternoon. Thank you very much for joining us. Well, first up, we are about to hear the first full-fledged budget from the new Indian Prime Minister. There is a lot of hope. Are you long Indian stocks? What will you look forward at all from the Indian government?
Well, basically, the current government has already implemented numerous reforms, and the budget will just confirm these reforms that have been implemented. And I'm sure that Mr. Modi would go at a much faster pace and implement further reforms if he could. But as you know, in India, we have to deal with an incredible bureaucracy, and so it's not that easy to implement everything you want. In the US, Mr. Reagan also wanted to cut down the bureaucracy, and he only managed to do that very partially, I mean, to a very small extent. And actually under him, budget deficits increased and the government still increased. So, I mean, it's a tough job, but I think in general the economy is okay. It's not going gangbusters, but it's okay. And in the meantime, the share market has gone up a lot over the last 12 months. And the valuations are, in most cases, no longer terribly compelling. I just looked at Nestle India. It's selling at close to 50 times earnings. So, you know, everything has to move in the right direction to justify these valuations.
So you would wait for a dip to buy? You wouldn't be a buyer already?
Well, I bought, as I told you, more than a year ago, because I'm the chairman of the India Capital Fund, and so I invested in India already over the last 2 years. And the India Capital Fund, because it was overweight banks, last year was up around 50%. So I'm not inclined to buy right now, although I think that the market could finish the year somewhat higher, whereby it all depends also on foreign investment flows and on foreign economies. And I believe, as I mentioned before, that the global economy is not healing, but is actually slowing down, largely because of a very meaningful slowdown in China.
Okay. So the India Capital Fund that you monitor will not be increasing their exposure to India right now?
Well, that doesn't depend on the India Capital Fund. It depends on investors who invest in actively managed funds. And one of the problems, the actively managed fund industry globally.
Coming to the global scenario, how do you see the Greek bailout talks play out from here on? Because we've got less than 2 weeks before, the deadline comes to an end.
What I wanted to say is actively managed funds have a tough time because money is flowing into ETFs that essentially track the index.
Okay. Marc, my next question was more about, the global scenario right now. We've got less than 2 weeks before, the Greek bailout comes to an end. That's on 28th of February. So how do you see the bailout talks evolve from here on?
Well, I think the Greek problem is real. In my view, it's less an economic issue than a political issue, because basically we have NATO in Europe with the US, and the US would hate to see Greece becoming or separating from the EU, simply because immediately there would be Russian influence in Greece or Chinese influence. So it's a geopolitical issue more than an economic issue. Economically, it's very clear. Greece cannot pay its debts. It's impossible. It's mathematically not possible. And so a solution has to be found, probably a compromise. Probably the Greek politicians will be bribed by some handouts or whatever it is, and they will continue to muddle through. The problem is that Greece should never have joined the EU in the first place. And when it joined and the first problems occurred, which was about 4 or 5 years ago, it should have been kicked out right away. Now the problem is that much larger. And I would say this is a problem for the global economy. McKinsey recently published a study whereby global debts today are $57 trillion larger than in 2007. So all we've done is essentially kick the can down the road. And the problems are still there. Excessive debt will make it very difficult for the global economy to again grow in a sustainable way.
Fair point. Mr. Faber, your views on crude and gold is what we would really like to hear. Crude has seen a bit of a pullback from that sub $45 that it saw. Do you think it has seen the bottom for now, or is this just a dead cat bounce and crude is going to see worse times?
Well, let's put it this way. We had a very sharp drop, and markets don't go up in a straight line and don't drop in a straight line, so I think we can have a rebound here. Some oil stocks are reasonably valued. Most analysts now predict that oil will drop to $20 a barrel and so forth, whereas a year ago they were all predicting that it will go to $150 a barrel. So I think there is a chance that oil is kind of bottoming out here. But I wouldn't bet too heavily on a major low, but I would bet on a rebound. I think oil stocks and oil servicing stocks could rebound here. Equally, I think that gold shares are the most attractive asset class within the equity markets. They've been hammered over the last 3 years, since 2011, and are showing signs of bottoming out.
Mr. Faber, what would be a ceiling for crude, though? I mean, even if you are a buyer in crude now, the commodity, I mean, not oil-related shares, what would it be $70? Would it be $75? At what point would you once again start selling crude, probably as a trading sell?
Well, I think we can rebound another, say, 15-20% from here.
Fair enough. Well, just one more question before we let you go on India itself. You said that you bought a lot of bank shares a year ago. You must be sitting on a lot of money. What's the current view? The latest quarterly earnings of the state government-owned banks was not much to write home about, except perhaps the big fellow State Bank of India. Some private banks also showed problems of borrowers not paying back their loans. At this point in time, will you further buy bank shares? Will you sell them out? Or will you just sit tight?
I think I'm the chairman of the fund. I'm not the manager, so I don't know exactly what the manager is doing on a day-to-day basis. But my sense is that he's holding on to his bank shares.
Right. All right, we'll leave it at that. Marc Faber, pleasure speaking with you. Thank you very much for joining us.
You're welcome. Bye-bye.
All right, so now that's an important view on commodity that we have to take on board, that maybe another 15-20%, but not more. So that would be maybe, depending on where you're positioned, a bit of a sigh of relief that it's not rising too much from current levels.